Welcome to the What to Watch video update. This is a video that I do every week where I go through and I pick out the charts, both positive and negative, of what I'm really watching right now. Now, this can change daily. Some of the charts that you see in this video I show every time, and whether they're leaning more positive or more negative. And then at the end, I've added a new section recently where these are things that are not really positive or negative. They're just things that we're watching at this time that could have an impact on the S&P 500. And the question I'm asking right now is, will the S&P 500 large caps find favor again? Now, it's not that they've fallen out of favor. They're not really under pressure. But this is what really has led the market higher since the October 2022 lows are the large caps in general and then the mega caps because the S&P 500 is a weighted index. And so when these bigger companies have an up day or a down day, it has more of an influence on the index. It's not necessarily negative if they're not performing like they were before, but it does limit the upside at times of what the S&P 500 index is. If we have the rest of the S&P doing better, they don't have as much of an impact as the large caps do. And so this can give the appearance of things really slowing down. Now, it could pick up and this could change at any time, but this is just what we're seeing after Friday's close. Before I get in looking at the charts, there's a thing that I have called the SPX investing program. It's up, it's going. There's a basic course that's on there. There are additional videos that I post that are not public videos. Feel free to check that out. It is free until the end of 2024, and then I'll be rolling out new courses and even additional videos after things launch to a bigger level in 2025. But there's a link that'll take you to the website and to a video that talks more about the program. If you have any questions, please feel free to send me an email. Here's an email address that I provide here. Also, even though this is the What to Watch video, and a lot of people like to see it because I kind of focus on the things I'm really watching, the daily video, where I go through a lot of charts that I show every day, because we're looking for just subtle little changes that are taking place, that this can give us some clues as to the shifting of the overall market. I know my videos are longer. I know I show a lot more charts. That's all by design because that's how you're really going to get insight as to what's going on. So feel free to check out the daily videos. They're longer, but it's where you'll get a pretty good grasp on what's actually happening. Okay, let's go through and look at the positive side of things right now. First of all, it wasn't looking very good. We were seeing a real mixed picture with a lot of our indicators. We were positive when you look at things based on moving averages, but some of our internal measures were starting to show some weakness. That started to change near the end of Wednesday's session. You can see we were down in Friday's session. Monday didn't, we tried to go up, but we really didn't recapture any of the lost territory here. Well, what we saw as we were going into the close, and that's what I focus on. That's when the smart money decides what they're going to do. And if we see a lot of buying going into the close, that's more positive. Where a lot of newer investors and folks that have jobs and they can't watch the market, they focus more on the open. Well, there's this old adage in the stock market that says the amateurs open the market, it's the professionals who close it. And that's what we saw in Wednesday's session, where we saw some real buying coming in here that we didn't see all that much of a change on a closing basis, but we saw some internal strength. That's why I watch a 10-minute intraday chart. I don't day trade. I just follow this to see what's going on while the market is open. And this is what I saw in here. Now, then on Thursday, we saw real big gyration right after the open as folks were reacting to things. And then we ended up looking like we were going to go lower. And then we saw that strength come back in after the open got dealt with. Then the smart money came in and actually drove things higher. And this is when things started to switch over more positive. Now, Friday's session was not all that great. We didn't really move up or down. We just kind of maintained the strength that had been captured in late Wednesday and in Thursday's session, but we ended up closing a little bit higher on that day. And so this is helping a lot of our internal indicators to turn more positive. But there's one concern here. we are not trending right now according to the ADX. There's a static line here at 20, and the black line is the ADX. It's below its moving average, which shows a weakening trend. And then when we drop below 20, that shows that we're not trending. Now, it could be starting to turn back up, and that will suggest the beginning of a trend here. Right now, though, we do default to positive because the green line is above the red line. Now, the green line didn't really go up in Friday's session, but it is above the red line, which now is declining. So in the short term, we're not trending. And in the intermediate term, we're also below 20 and we're below the moving average. But the green line is on top and the red line's going down. If we could see the green line continue to go up, the ADX turn back up, get above 20, get above its moving average, that would suggest a stronger trend. But we're not seeing that now, but we are still positive here. And then we're just a little bit at this dashed line. This is a pivot point. And I know it's really hard to see because we've got the next pivot points getting ready to be drawn in here when we get into the month of December. But we had come down and we were still above this one pivot point. I was watching that as potential support. We never got down to that level. We never got down below the 20 period moving average. Now we've been going back up, and this could be acting as some overhead resistance. We haven't really cleared this area. This is just a daily chart here that I'm showing. And we look at the condition of the short-term trend. Now, my definition of short-term is the 20 period moving average. Some folks use different numbers. That's okay. We had fallen below the green line and the blue line, and that was showing that the short-term trend was vulnerable. But when we look at the next chart, we never fell below the simple or exponential moving averages. So it was still holding together. These lines move a lot quicker, and that's why I show this as suggesting the condition of the trend. We just are looking at this to see, are we seeing more strength or weakness right now? We had been seeing more weakness, but we didn't really show that when we look at our other moving averages. Now we're starting to come back above these lines. So we are improving here in the short term. And then this is the 20 period simple and exponential moving averages. You can see we actually ended up using the simple and exponential versions here as support, and we were able to bounce up off of that. I'm not even dealing with the 50 and 100 and 200 period moving averages right now because we're still well above those levels. What I've been mainly focusing on here is the short-term trend, and this is still holding together and looking positive. But we just look at the condition of the intermediate term trend, 50 periods, and we're coming back up above the blue line and the red line where we had dropped down below. Now, these lines were still going up, and we were still well above the simple and exponential moving averages. But I like to keep an eye on this to see, is there weakness coming in? Yes, there was. And that's why some of our other more intermediate term indicators were turning negative. Now that we're coming back up, it's helping those other indicators to look more positive again. Also looking at sentiment, where we got right down to this 50 level, and we tend to go with this. When it's going up, we're positive. When it's going down, we're negative. Until we hit about 75 to the upside, that means we're getting a little too positive. Or if we get all the way down to 25 or below, that means we're getting too negative. 50 is kind of the line in the sand between positive and negative. And the fact that we're still going up here is more positive from a sentiment view. And we still have more room to go to the upside without necessarily getting extreme. We are seeing some improvement here with the advanced decline line based on price and volume. We're just barely setting a new all-time high here with the advanced decline line based on price. We have set a new all-time high based on volume, but we haven't done that yet with the index itself. And this could be positive. When we see volume and price as measured by advanced declines leading ahead of what the index itself is actually doing, that could end up being positive. It's also a little more positive that we're seeing volume stronger than price right now. See how it went up a little bit more recently? So this is positive overall when you look internally at the S&P. We're also seeing a big improvement here. Now, the 5 period moving average is still going down, but it's starting to turn up. The 10-day is starting to go back up. This is new highs minus the new lows. And when we see a lot more green than red, that's positive. As we were under some pressure after the election, we saw the run up and then the pullback. We were seeing a bit of an expansion of the new lows, and that was causing some concern. Now we're seeing more of an expansion of the new highs and really no new lows to speak of that are being generated. So this internal measure is looking more positive as well. And accumulation distribution. We had turned negative with this because we had dropped below this red line, the moving average. Now we've been able to cross back above it. And the longer we can stay up here, the red line itself will start to go up. So this has gone from negative a week ago to now being positive. And we were looking more negative in the short term with the advanced decline ratio. We dropped below zero with the blue line. Now we're back above. We came down, didn't quite go negative with the intermediate term based on 39 periods. It's now going back up as well. So we're looking more positive here. And this was a concern. This is a smart money indicator. It uses price and volume to be calculated. It's called the Chaikin money flow. And we were pretty much going sideways here and actually still declining with the moving average. Well, we started to see some improvement as the week unfolded this past week. And then eventually in Friday's session, we turned back to positive. So we have two smart money indicators. Accumulation distribution is positive, and now the Chaikin money flow is positive as well. The Chaikin oscillator is above zero and going up. That's another smart money indicator. So all three of them are now positive. The vortex has the green line going up and the red line going down. That's positive. And we're seeing discretionary really doing well. It's doing well all by itself. This is an equal weight version of the discretionary ETF, where staples have been under pressure. And discretionary would be like Tesla, Amazon, things that make life fun. Where staples would be toilet paper and toothpaste. This is what the market gets into when it's more defensive. This has been still in an uptrend by itself, but it's falling under both moving averages. What's holding up is the ratio between discretionary and staples. This is going up and in an uptrend, and that's more positive for the market. And the VIX, after being really high before the election, is now dropping down. When the VIX is going down, that's more positive for stocks. And we're kind of in between right now with the momentum of the VIX. It had been coming down, but then was starting to turn up as we got beyond the initial time after the election. And then we had that a week ago, that was pretty much sideways and starting to show some exhaustion. But we're not quite above the moving average yet. If this could turn and go back down, that means the VIX is going down, which is more positive for stocks. And we look at the cumulative advanced decline line for the S&P based on price, not surpassing this previous all-time high, but based on volume, we are. And that suggests that more stocks inside of the S&P are seeing healthy volume and a lot of buying. And when volume leads price, that can often be positive. And we were negative a week ago with the S&P McClellan oscillator because we were below zero. Now we've crossed back above zero, so this is turning positive. And when the McClellan oscillator is positive, now we see the summation index turning back up based on price and volume. This was another concern as we were declining here a week ago. Now this is switching back. We're also seeing more broad market participation with the McClellan oscillator. The NYSE McClellan oscillator crossed back above zero as well after it had been negative. And so the summation index for the NYSE based on price and volume are starting to turn back up. And we're seeing volume turning up with a little bit more enthusiasm, which could be positive. And we were negative a week ago with the Swenlin trading oscillator. We were below zero based on price and volume. Now we've crossed back above and both are going up. So that has gone from negative to positive there. We never did turn negative with the parabolic SAR. The dots are still underneath, and that is still positive. Momentum, because we've been shifting, we were gradually looking more negative, and then now we're seeing some more robust strength coming back into the market from the end of Wednesday through Friday's close. And so it takes longer for the oscillators to catch up. We're kind of right on the moving average here with slope, but we're above this green line, which sometimes means we're getting extreme. We're turning up, but still a little bit negative here with the TSI. These are short-term oscillators. And then I have three intermediate-term oscillators. We're turning back up, but improving with the MACD, the PMO, and the PPO. And our long-term oscillators, they never did really have a chance to go negative. They're still remaining more positive. That's what the tricks in the KST. Moving averages, we held up above the 20-period moving averages, and now, at least for the time being, we're bouncing up off of that. We were a little concerned here with the bullish percent index a week ago because we were going down. The context was that this was declining, even though it's still above 50. Now it's starting to go back up and turning more positive. We're also going back up with the NYSE bullish percent index and the NASDAQ 100 bullish percent index. And then we look at those stocks inside, excuse me, those stocks inside of the S&P above their 20-period moving averages. We didn't quite get down to 50, but we were seeing some weakness here. And now this is starting to go back up. This is better for the short-term trend. And then here's a study here. We actually crossed above 70 again. This is showing some strength building in the short-term trend. Also going back up with those stocks above their 50-period simple moving average, the 100-period moving average study, and the 200-period moving average study are all going up. So on all different time frames, we're seeing an improvement based on those stocks above their moving averages. And then we're still looking good here. And I'm trying to find the calculation for R3. And I'm not really coming up with anything yet. If any of you know of anything, let me know. It'd be nice if I could just pump in the numbers and see, are we getting close to an R3 up here? Because stockcharts.com, it only calculates R1 and R2. But this is still looking good. And we're still looking good longer term. When we hit that low back in late 2023, you can see that we're setting a series of higher highs and higher lows as we've been going up. Now, this is something that we've been waiting for a long time, actually going back to about the first quarter of 2023 was the long-term chart of the special K. This is a very long-term oscillator. It doesn't give us very many signals. I don't talk about it in the daily video because we get maybe one or two signals a year with that chart. The weekly chart had been negative. We were below the red line. We're finally crossing back above it. And you see, going back here to late 2014, once this thing crosses, it tends to stay above or below that line for a long time, and this could be longer term positive. Then we look at a broader market measure here, the cumulative advanced decline line for the NYSE, setting a new all-time high, showing a real improvement with the regular NYSE advanced decline line. We were dropping below the moving average. Now we're going back above it. And this is calculated in a slightly different way. Another NYSE advanced decline line also coming back above the moving average, showing some broad market strength. Then we look at common stock on the NYSE with the based on price, not setting a new all-time high yet, but still looking solid. We are setting an all-time high here based on volume, and that could be leading price higher. And we're seeing a much improved picture with our advanced decline line studies. We were dropping below the moving averages with the NYSE common stock. Now we're back above that. We never dropped below with the S&P. Now we're bouncing up off of that. And the mid caps and small caps are really showing some improvement as well. And then we did set an all-time high on Friday with the equal weight version of the S&P, not the weighted version, not the regular one. And we haven't set an all-time high with the equal weight version of the QQQs here. So right now, this is a non-confirmation. If we do set another high here with the equal weight and with the QQQ equal weight, that would be more of a confirmation there. The Wilshire, not at an all-time high yet, but still looking really solid. The total U.S. stock ETF, also not at an all-time high, but looking really solid. The Dow, not at an all-time high, but showing a real improvement here. The NASDAQ, we stayed above this pivot point here, and these seem to be really important for the NASDAQ and NASDAQ 100. And now we're bouncing up off of that, and we're waiting for the new pivot points for the next month to calculate. And the NASDAQ 100 also held up above this pivot point and not really showing a lot of robust strength, but still hanging in there fairly strong. The NASDAQ is outperforming the NASDAQ 100, where earlier in the year it was just the opposite, with the NASDAQ 100 outperforming the NASDAQ. This means more broad participation in the upward move. Small caps, are we going to get, let me try that again. Are we going to get fooled again here? It seems like we have this going back to 2023, really nice run up, give back, run up, give back, run up, give back, run up, give back. What's happening here? We had a nice run up after the election. We did start to give it back, but now we're seeing some renewed strength here with the small caps. And we also look at another small cap index, the Russell 2000, looking pretty solid here, but not at an all-time high yet. Above 50 and going up with the RSI, and the momentum is starting to shift back over and look positive as measured by the MACD. But when you compare them to the S&P 500, yeah, the small caps are improving, but not enough to change this long-term trend over to positive yet. So I watch this all the time, and we'll just see because there were a couple of fake outs here where it looked like here we go, here we go, here we go. Well, until this blue line crosses above the red line, that's when we'll start to take small caps more seriously, in my opinion. But I don't do them anyway. I just focus on the S&P 500. And small caps doing better could benefit from a stronger economy, from interest rates coming down, which have been going up, but the Fed's been cutting rates, and a more pro-growth environment. And we are seeing an improvement here with small cap growth to value, but it's still in a longer term downtrend. And mid caps doing pretty good, setting an all-time high here. And we're seeing an improvement, but still in a downtrend when we look at mid cap growth to value. And we want to keep an eye on this. This is the Qs, the NASDAQ 100 to the IWM, which are the small caps. We're right about at this blue line here, and we've been hanging around it for quite a while. If this really starts to drop, that means that small caps are outperforming the NASDAQ 100, and that could be a sign of some problems. But we're not really seeing those problems yet. The perma bears, they're so sure that we've already been in problems and the crash is just around the corner. Then we're looking at the ratio between staples and tech. This was starting to bounce back up when we went through kind of a rough summer. Now this is coming back down, and we're actually seeing a death cross here, meaning that staples are underperforming tech. Staples are more defensive. That's what folks get into when they're really worried about a market decline, where tech is growth. And this ratio going down would be more positive for the tech sector and for the market. The FANG index not back at an all-time high yet, but still hanging in there. And I've been pointing this out too. There's a shorter term trend line. We've not been able to get above that, but we've been holding up above this longer term trend line that acted as support a few times along the way. Are we going to be able to break above the short term trend line? Now, these lines are going up, so we could actually bounce around in this channel here and still be doing well with the FANG index, but it would be even more positive if we were really to break to the upside. And then the weekly chart of the NASDAQ 100 still looking really solid here. And the ratio between the NASDAQ 100, which is growth, and Dow, now they just put NVIDIA into the Dow, so that may be helping the Dow to hold up a little bit better. But this ratio is still looking pretty solid. It's not falling apart. When we look at the S&P to 3 to 7 year bonds and do a ratio, this means the market is still anticipating a soft landing, meaning that we're not going to go into a recession. We don't know, and this could change quickly. It's changed a few times as the market was seeing some doubts, but for right now, the market is pretty confident about a soft landing. And then we look at a broad market measure, the S&P 1500, and compare it with short-term bonds, 1 to 3 year, showing how the broader market is doing well, but not back to an all-time high with this ratio. Another broad market measure with further out bonds, also not back at the all-time high, but still looking solid. The tech sector at the high end of the rainbow, it'd be better for the S&P 500 and the NASDAQ 100 if this ratio was to go up with even more strength, but it's still looking positive. And we look at S&P growth to value. Now you notice that the growth to value ratio for the small caps and mid caps were in downtrends. Here we're still in an uptrend. We're not really breaking out right now, but we're still looking positive overall. It'll be more positive if this ratio continues to go up. If it falls down, that will be more negative. And we look at a growth versus a value ETF and do a ratio, coming back down a little bit as we're hanging out at the top end of the rainbow. If this continues to fall, that will cause some more concern. If it goes back up, that will be more positive. And large cap growth, not at an all-time high yet, but still holding together nonetheless. And we look at some growth to value ratios. The Qs to S&P actually falling below its moving average. This is what's looking strong right now, discretionary to the S&P, and we're above an advancing moving average. And large cap growth to large cap value also dropping below the moving average. That's why I asked the question, will large cap growth come back in favor now? Because that's what we need to see if these ratios are going to improve and the S&P is really going to have some upside potential. It could still go up anyway, but when the large cap growth really gets in gear, that's what really helps things. Then we look at the large caps below its moving average, but we're seeing an improvement here with the mid caps and the small cap growth to value ratio. And this had turned negative, and I brought this up a week ago. We're actually switching back to positive. This is a broad market measure of the 5-period moving average of the highs minus the lows. This is turning back positive again. So that's looking better for the broad market. And then seasonality. We have Thanksgiving through the Santa Claus rally since 1950 with the S&P. We're up 79.73% of the time with an average return of 3.78. When we do have downtimes, which are 15 times, we're down 2.13%. Must have been a nasty Christmas. And then looking at the Russell 2000, these are the small caps going back to 1979. They have a pretty good return rate and success record during this time as well. And this is the Stock Traders Almanac chart where we're coming back in, at least finishing out the month of November, except for maybe the last day here. At least this is the Russell 2000 during an election year. But we are in a period of positive seasonality now, which has been helping the market. Now we look at the negative side. Value had a good day on Friday. Now, value can go up, but we would like growth to go up even more. And this is an intraday chart based on 10 minutes where we see the red line above the blue line. It's more positive when the blue line's above the red line. Now the red line's above and the blue line was down where the red line was up. And that's a little bit of a concern to us. And we did see a bottom here back right around Halloween, and then we saw S&P growth of value intraday really looking good. It had some weakness and then came back here. Now it's starting to show some weakness again, and we're coming back down to these previous levels. It's not necessarily the end of the world, but we would like to see growth outperforming value on an intraday basis. This is something that it's longer term. It's more intermediate to even a little bit long term. This is a 10-day average of the highs and lows for the S&P 500. We spent most of 2024 and a lot of 2023 just pegged above this green line. Well, and we were up here after the election when we were going up. With the weakness that we've seen recently, going about halfway through this past week, this is really dropping down. Now, what we want to see happen is this continue to go back up. If this continues to fall, that'll be more negative for the S&P. And the momentum for the NASDAQ 100 is measured by the PPO. It's still negative. So these move a little bit slower. It's not really picking up some of the strength that we saw later in the week this past week, but this turning back over above its moving average would be more positive. But right now, it's still negative. This is a concern too. The semiconductors, a big part of tech, and tech is a big part of the stock market. We're actually seeing kind of a weak death cross here. We're dropping below the 50 and 200-day moving averages, and we need to see more strength here. Now, this is what really helped lead the market higher back at the end of 2022 and into 2023 and for most of 2024. This lagging behind is a bit of a concern. Now, if we recover, okay. We've had weakness before only to have it bounce back. But if this continues to drop, that could put some weight on the market longer term. We also look at the semiconductors against the Dow and take a ratio. I pointed this out a week ago, and 2 weeks ago, this was the only negative chart after the election. This ratio is still going down, even though it ticked up a little bit here. It was down in Friday's session, but if this continues to drop, that means the semiconductors are underperforming the Dow, and that could be more negative for the market as well. And then one of the areas that I'm watching right now, we want to keep an eye on jobless claims. And these are folks that are filing for first-time unemployment, really dropping off. That means there's not as many of them, and the 4-week moving average is going down, and that's positive. But when you look at the continuing claims, this looks out into the future, folks that are longer term unemployed. This continues to go up and the moving average is going up as well. And we're likely to see volume really drop off. Thanksgiving will be Thursday. Friday will be an abbreviated session. We don't have any economic reports coming out on Monday. There may be a whole lot of folks that end up taking the whole week off. And so volume is likely to be below average, but it could always pick up and price action could be more stronger. If somebody, like a big hedge fund or some smart money comes in and buys or sells, that could really show price action really moving. Now, in Wednesday's session, we're going to get a real long list of economic reports because we're going to be closed on Thursday. So all the reports that would have come out on Thursday are coming out on Wednesday. And we already had a long list for Wednesday. So we'll have to see how the market reacts to those. But the takeaway here is volume may continue to be below average. We're watching the skew index. This is a variation of the VIX and it's coming back up into the red area. Now I've got it in the watch area because it doesn't necessarily tell us what direction things are going to go. And since we're up here, now this could still continue to go up, but there are times when it marks a high, a low, or a continuation. So we'll just keep watching this to see what the market does and then what happens and what brings this index back down below the red area. We want to keep an eye on the 10-year yield. I've kept it in the watch area because we've been kind of chopping more or less sideways right now, right around a little bit above the 4.4% level. The concern has been that interest rates are really going up. But why are they going up? The Fed's been cutting rates. Right when the Fed cut rates, that's when the 10-year yield started to go back up. Is that because of the hope of economic growth? Okay. Is that the fear of inflation? Okay. I mean, both of those are legitimate, and we'll have to see how they get played out here. But we do know that interest rates are going back up, and that could put some pressure on stocks. We have to try to figure out why are they going up. And of course, everybody has an opinion. We look at charts. And we want to keep an eye on the dollar. This could also put pressure on stocks because a stronger dollar tends to not look as good. We've just been ripping up here. Now, we're still technically in a downtrend, but the longer we stay above both of these lines, we're going to see a golden cross here. And this is a really high level that we haven't seen in quite some time. And this is against the euro, the British pound, and the Japanese yen. Those are the three major currencies. And so when you have the election that is now come and gone and things seem to have held up well with the system, you have a president who's already had a 4-year track record, who seems to be more pro-business, who promises to come in and change a lot of things by doing away with a lot of spending. Well, you take all that together and it has a tendency to strengthen the currency against the other currencies. And then we're keeping an eye on oil because not only are the things going on between Russia and Ukraine with the potential escalation there that the market's really not paying attention to, we're also watching things between Iran and Israel, which is still going on, but it kind of comes and goes out of the pop news cycle. And then we do have another Hindenburg Omen, but it's not confirmed at this point. So if you want to stop this and read through, there are three criteria that make up a Hindenburg Omen. Now, the perma bears love this thing. And that's why I didn't use it for a long period of time, because I'm not a perma bear. I'm not a perma bull. I'm a perma realist here. Markets go up and markets go down, but they go up 70% of the time and down about 30% of the time. You have perma bears who think it should go down 100% of the time and that next crash is coming. Okay, 5 years, it's coming. 10 years, it's coming. 15 years, it's coming. Okay, but we do have one, and this talks about how this whole thing was created. Now, we did get one triggered back here on November 20th. Now, it doesn't mean anything until we get another confirmation signal, and that has to happen by December 19th. We need two spikes up to have it be confirmed. The perma bears are already running with this. There's a couple that I loosely pay attention to them. I get their emails and I see what they're putting in the subject line, and they're just saying Hindenburg signal triggered. No, it's not. The initial signal is there, and we did have a confirmed signal last September, but it didn't really lead to anything. So it doesn't mean these things are automatic, but we still want to pay attention to them because we had a lot of spikes right here right before the COVID crash. And we had a lot of spikes here, and they're spread out over a period of time right before we ended 2021, and then we went into 2022. So we want to pay attention to this, but we don't want to make decisions around this either. We use the other charts together to actually evaluate what's going on, but we do want to know this is in the background. So thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.